For 34 years, a whole generation of Japanese investors waited just to break even. Someone who bought at the very top in 1989 would not see that level again until February of 2024. It was the aftermath of the largest financial bubble a modern country has ever inflated. So how does the world's rising superpower end up standing still for 3 decades? Let's start in 1985. In 1985, Japan was the envy of the world. In 40 years, it had risen from the ashes of war into the second largest economy on Earth. Its factories outbuilt Detroit, its cars and televisions filled every shop in America, and the phrase on everyone's lips was that Japan would soon overtake the United States entirely. Best-selling books in America carried titles like Japan as #1, and business schools taught Japanese management as the shape of the future. But that success created a quiet problem. Japan sold the world far more than it bought, and all those exports piled up a mountain of foreign cash. To American factory towns losing work, it looked like the game was rigged. And so the finance ministers of the 5 richest nations sat down in one New York hotel to do something about the price of money itself. Almost no one in Tokyo understood that their fix would light the fuse. The meeting was the Plaza Accord, signed on the 22nd of September, 1985. The plan was simple. Make the dollar cheaper and the yen dearer so American goods could compete again. It worked almost too well. In under 2 years, the dollar fell by roughly a third against the yen, from around 240 yen to $1 down to about 150. For Japanese exporters, this was a disaster. Suddenly, every car and camera they sold abroad earned far fewer yen, and the country tipped into what the Japanese called the Indaka recession, the slump of the strong yen. Exporters demanded relief, and the political pressure to do something grew enormous. Tokyo's leaders wanted that slump to end quickly, so they turned to the one lever a central bank controls best, and they pulled it hard. The lever was the discount rate, the interest rate the Bank of Japan charges other banks. When it falls, borrowing gets cheap all the way down the line. Starting in 1986, the Bank of Japan cut that rate 5 times, from 5% down to just 2.5% by February of 1987. That was the lowest it had ever been. And then, fatefully, they left it there for more than 2 years. The strong yen slump was already fading. The economy was growing again, yet the cheap money kept flowing. Picture a bathtub with the taps wide open long after it is full. Money with nowhere productive to sit goes looking for a home, and it rarely picks a sensible one. In Japan, it poured into 2 things above all: stocks and land. Here is where a bubble becomes self-feeding. Japanese banks were flush with cheap money and desperate to lend it, and the safest collateral they knew was land. In a country where land had almost never fallen in price, a rising plot was as good as gold. So a company would borrow against its land, use the loan to buy more land, which pushed land prices higher, which made the original plot worth even more, which unlocked a bigger loan. Round and round it went. Regulators even nudged the banks along through an old practice called window guidance, in which the Bank of Japan quietly signaled how much each bank should lend. The message was, lend. And lend they did, with less care for who could pay it back than almost anyone in the world. The banks did not feel reckless. Every loan was backed by land, and land everyone agreed was the one thing that simply could not lose. The numbers this produced still sound made up. Across the 1980s, land prices in Japan's 6 largest cities rose several times over, and at the peak, the property beneath the Emperor's Palace in central Tokyo was, on one back-of-the-envelope estimate, valued at more than all the land in California. Now that particular comparison is a rough calculation, not a receipt, and honest historians flag it as an estimate. But you don't need the trophy line. The measured figure is enough. The official land price index for the big cities more than tripled in a handful of years. An ordinary Tokyo family could no longer dream of a home, while on paper the nation had never been richer. Everyone could feel that something was strange. Almost no one wanted it to stop. The mania did something stranger still to Japan's famous companies. With their share prices soaring, firms discovered they could raise money almost for free by issuing special bonds tied to their stock. Then, instead of building more factories, they poured that money straight back into the market. The Japanese had a word for it, Zaitech, roughly financial engineering. At the height of it, several household name manufacturers earned more from playing the markets than from making the products that made them famous. A car company that made more money from trading than from cars is not a company anymore. It is a hedge fund with a factory attached. It felt like genius while the line kept rising. By the end of the decade, a bad month in the market could dent a car maker's profits more than a bad month selling cars. It was in truth the same money running in a faster and faster circle. The money spilled out into the world in ways that made headlines. Japanese buyers picked up trophy real estate in New York and a Hollywood film studio, and paid record sums for impressionist paintings that then vanished into private vaults. But the purest sign of the madness was closer to home, and almost nobody outside Japan noticed it: golf. A membership at an exclusive Tokyo golf club became a tradable asset, quoted in newspapers like a stock, and at the peak, a single membership could trade for the price of a house. There was even an index tracking club prices, rising in lockstep with the land beneath the fairways. When the right to swing a club on a Sunday costs as much as a home, the market is no longer pricing golf. It is pricing belief. And belief, unlike land, can vanish overnight. All of it pointed at one number. Climbing on the front page of every newspaper, the Nikkei, the index of Japan's biggest stocks. On the last trading day of the 1980s, the 29th of December 1989, it touched an all-time high of just under 39,000. It had nearly tripled in 4 years. Brokers were telling clients it would reach 80,000 by the middle of the 1990s, and clients believed them, because so far the line had made believers of everyone. A handful of economists warned that the arithmetic no longer added up, but in a market that had proven every doubter wrong for 4 straight years, warnings were for cowards. What almost no one in that crowded, champagne-soaked market knew was that the peak had already arrived. That December day was the top. Everything after it was the long way down. Because just days earlier, someone had decided the party was over. A new governor had taken charge of the Bank of Japan that December, Yasushi Mieno, and he saw a bubble he was determined to kill. On Christmas Day of 1989, he raised the discount rate, the third hike in 7 months. Then he kept going. Over the next 8 months, the rate climbed from 2.5% all the way to 6%, the sharpest tightening the country had seen in a generation. Here is the thing to understand. The crash was not an accident that befell Japan. The central bank pulled the plug on purpose, believing a controlled deflation was better than an uncontrolled one. They got the deflation. Controlled, it was not. Higher rates cooled the stock market first, but land was the real target, and for that the government reached for a second, blunter tool. In March of 1990, the Ministry of Finance issued a directive with a dull name and a devastating effect: total volume control. It ordered banks to hold the growth of their real estate lending to no more than the growth of their lending overall. In plain terms, stop feeding the land machine. And the machine, remember, only ran because the loans kept getting bigger. Cut off the new loans, and the whole spiral that had lifted prices for a decade began to run in reverse. Buyers vanished. Prices that had only ever gone up discovered, for the first time in living memory, that they could go down. The land price index in the major cities rolled over and began a slide that would run, almost without pause, for more than a decade. The fall, once it began, was merciless. The Nikkei lost nearly half its value in 9 months, dropping from almost 39,000 toward 20,000 by the autumn of 1990. Land took longer, because property is slow, but it followed the same cliff, and in the big cities it would eventually lose the great majority of its peak value. By the most cited estimates, something on the order of $2 to $3 trillion of paper wealth simply evaporated, though the exact figure depends on what you count and when. Numbers that large stop meaning anything. So think of it this way instead. Every family that had borrowed against a home, every company that had bet its treasury on the market, every bank that had lent against land, woke up to discover the collateral was worth a fraction of the debt. Now comes the part that puzzled economists for years. The question every viewer asks: why didn't they just fix it? Japan cut interest rates, eventually all the way to zero. It spent enormous sums on public works. And still the economy barely moved. The answer, argued most forcefully by the economist Richard Gogh, is that this was not an ordinary recession, but a balance sheet recession. When the bubble burst, companies were left owing far more than their assets were worth. So they stopped trying to grow and quietly devoted every spare yen to paying down debt instead. In that world, it does not matter how cheap you make borrowing. Nobody wants a loan when their only goal is to owe less. Cheap money is a rope you cannot push. An entire nation, all at once, chose to save rather than spend. 2 decades later, when America and Europe faced their own crash in 2008, their central bankers studied Japan closely, terrified of repeating exactly this. The damage worked its way through the system slowly, like a crack spreading through a foundation. The banks that had lent so freely against land were now sitting on mountains of loans that would never be repaid, so-called bad debt. Rather than admit the losses, many kept the failing borrowers on life support, lending them just enough to survive, which turned healthy banks into hostages of dying companies, the famous zombie firms. For years, the government insisted the system was sound. Then, in the space of a single month late in 1997, a major bank and one of the country's oldest brokerages collapsed, and the pretense collapsed with them. The cozy old order, in which strong banks were expected to quietly carry the weak, even had a name, the convoy. And the convoy had finally run aground. Cornered, the Bank of Japan began improvising tools the world had never really seen. In 1999, it cut its main interest rate to essentially zero, a policy so novel it got its own name, the zero interest rate policy. When even that failed to spark growth, in 2001, the bank started simply creating new money and using it to buy up government bonds, an experiment it called quantitative easing. Japan was now the laboratory of the modern central bank, testing every emergency measure that Europe and America would themselves reach for a decade later, during their own crisis in 2008. Years later, a program nicknamed Abenomics would throw everything at the problem at once, and even then the climb out of deflation came slowly and late. The uncomfortable lesson Japan was teaching was that once a great bubble bursts, there may be no lever left that works quickly. The tools do not run out, their power does. Behind the statistics sat a generation. Young people who left school in the 1990s walked into a frozen job market that Japan named, bleakly, the employment ice age. Lifetime jobs their parents took for granted simply were not there, and many never fully recovered the careers they lost. Prices themselves began to drift downward year after year, a slow deflation that sounds pleasant and is quietly poisonous, because when things will be cheaper tomorrow, everyone waits, and an economy of waiting stops moving. The stall seeped into everything, even the birth rate, as a generation that could not count on steady work, put off marriage and children. Put the whole lost stretch in one figure, adjusted for all of it. Japan's economy in 2017 was barely larger than it had been 20 years earlier. Not shrinking, not growing, simply, eerily, still. And the Nikkei? The index that had touched 39,000 in 1989 spent the next decade falling. And at its worst, in 2009, it traded below 8,000, roughly a fifth of its peak. Then it spent years, and finally decades, climbing slowly back. Not until the 22nd of February, 2024, 34 years and 2 months after that champagne-soaked December, did the Nikkei finally close above its old record. Think about what that number means for a human life. A worker who bought at the top and held on retired, and in many cases died, before the market they trusted ever made them whole again. That is the true price of a bubble. Not the wealth it destroys in the crash, but the years it steals in the silence afterward. So what can we take from Japan's long silence? Not a prediction. Every bubble wears different clothes, and anyone who tells you exactly which market is next is guessing. We explain history here, not investments. This is not financial advice. But the mechanism rhymes across history. Cheap money looks for somewhere to go. It finds an asset that supposedly cannot fall. Belief does the rest, until a central banker decides the belief has gone too far. What made Japan singular was not the mania, which is ordinary, but the length of the hangover, the way a whole society, trying so hard to be prudent by paying down its debts, together talked itself into standing still. That is what makes it a cautionary tale rather than a horror story. Prudence, shared by a whole nation at the wrong moment, became its own kind of trap. The numbers on our cards all trace back to real archives, and you can check them. The deepest lesson does not fit on a card. A bubble is a story about the future, and when it breaks, the future is exactly what it takes away.